I'm your host, Bruce Weinstein. This has been a 5-part episode on all the different areas of why people need life insurance. We've touched on the various aspects of mortgage protection, college planning, income replacement. We talked about estate planning, pension maximization. The last one here we're going to talk about in these episodes is going to tie in the big buzzword of the day is be your own banker, or something called infinite banking. Now, for me personally, over the years, I've used it more creating private pensions using the life insurance world for self-employeds making high amounts of income that can't fund IRAs and 401ks to the type of dollars they really want to put away and save. And so one of the beauties of using life insurance as a way to create a private pension is there's no limit of what they can contribute. So they can put away $50,000, $100,000, $200,000 a year. They overfund a life insurance policy. It grows over time. And then ultimately they take that money out and create a pension cash flow. So I'm going to speak more from the private pension side, and I'm going to tie it back into infinite banking and being your own banker concepts. But before I dive in, as always, please make sure you like, share, and subscribe so you can keep current with all our future episodes. So what exactly does the private pension world look like? Well, first and foremost, never underestimate or never forget the fact that this is always using life insurance as the umbrella to create this investment vehicle. Now, why is that important to know? Well, certainly there's costs, COI, cost of insurance, but one of the big benefits of using life insurance in this world of savings is you get tax-free or tax-deferred, but in my case, tax-free growth on your money. Everything that stays inside the life insurance grows and compounds out tax-free. Now, the way I create private pensions for my self-employed clients or my high net worth clients is we're going to overfund that life insurance. We're going to forecast out a rate of return that's modest. We don't want to be overly presumptuous on rates of return, maybe 6 to 8%. You don't want to give people promises of 10 and 12. This is not the stock market. This is going to be more conservative as far as the growth of the money. But ultimately what's going to happen is we're going to create a tax-free income stream for them later. So stay with me here. So let's say you've got a 40-year-old doctor who's got a lot of discretionary income, and he wants to put away $200,000 a year into a private pension design. Now, first and foremost, he's got to buy a certain amount of life insurance to make this work. He's got a family. This is going to kill 2 birds with 1 stone, right? Because he needs life insurance to take care of his spouse. If he has a mortgage, his kids' college, as events are going on, he's going to have this need for some life insurance anyway. But on top of that, he's creating a tax-free vehicle for himself using the life insurance. So he's going to fund, again, I'm just going to make up some scenarios here. He's going to put away for 20 years, $200,000 a year. That's accumulation of $4 million that he has built up inside the insurance. Now, I don't know what the math is over the 20 years and the calculations, but that's going to grow at maybe 6, 7, 8%. He's going to get 20 years of growth in that money. And then he's going to start to take money out at 60 because he wants to retire. The strategy with private pension is you're going to do the following. We're going to take the $4 million he put in, and we're going to return that back to him. And the terminology here is called basis. He's going to start to withdraw the $200,000, $300,000, $400,000 of income now in his 60s and 70s, and it's all going to be tax-free to him. Because by pulling his own money out, using the basis first, so the terminology is called surrender to basis, going to pull that money out. Maybe it's going to take 10 years, 5 years, depends on what his spigot is. How much does he want back out? And then once he's used the $4 million, the remaining cash value, well, that money's been sitting there. That's been compounding tax-free all those years. If he pulled all that money out straight up, that's a taxable event. So what he's going to do is he's now going to surrender to basis, and then he's going to switch, that should be loans, he's going to switch to loans. He's actually going to borrow the capital, the cash value that's been built up, several $1 million, and he's going to use that as a loan against the policy. And in doing so, he's not violating the life insurance umbrella of tax-free growth. And so this is how people are getting money out of their policies on a tax-free basis. Now, the key piece is here to make sure what? This policy can never lapse. Lapsing is bad. We can't afford to have this policy lapse. The policy lapse for lack of money, lack of funding, all those loans are going to come due. He's going to have the taxation now to pay against those loans. So we never ever want a policy to lapse. So you have to be very careful in the design of these plans. Make sure you're not being overzealous in your rates of return. Make sure you're not being overzealous on the amount of money you withdraw. So we try and stay within a bandwidth of success to make sure that they're getting a good, respectable return on their money, as well as a distribution. Again, this is just a generic scenario. You always want to do your own homework in here. Now, the private pension concept is now what people are using more if I go over to the be your own banker and the infinite banking. What you're seeing a lot of people doing today, what's become very popular, is very quickly funding and overfunding life insurance and using the equity that is built up to borrow their own money back. Be your own banker, infinite banking. Those terminologies are going hand in hand. Very popular right now. But you have to keep in mind, there's always a cost of insurance. So these young people who are buying multi-million-dollar policies and funding it with that capital to then borrow against it, to buy real estate, to buy their car, to do other transactions, I'm not against it, but understand there's still a drag. The drag is always cost of insurance. So make sure you know your numbers. I'm a big numbers guy. You want to make sure you know your numbers of what the cost of insurance is. Cost of insurance on a 30-year-old is dramatically less expensive than a 60-year-old. So these scenarios don't work ideally for everybody. That's why you want to make sure you do your math, you do your homework, okay? So I hope this has been helpful for you. If you're self-employed, you have excess cash flow and capital, you want to create a retirement plan for yourself. You're not getting one at your employer. You are self-employed, you're the employer. You can only do so much that your accountant's allowing you to set up in a retirement plan like a 401k. You have a lot more discretionary dollars. This is definitely one way using life insurance, creating a private pension for yourself. We're always happy to help design something for you. Take a look at this. If you're interested in infinite banking or being your own banker concepts, give us a call. Again, I hope you've enjoyed my series on the variety and various reasons of why you need life insurance. Please make sure you like, share, and subscribe. Stay tuned for future episodes. We get into disability, long-term care. Check out our previous episodes on health insurance, Medicare, and annuities. We got plenty of new content coming out to you every month. Again, I'm your host, Bruce Weinstein. This has been another episode of Ask the Planman. We'll see you next time.